Hi everyone, welcome back to the Market Chat. My name is Richard Moglen, and joining me today is Patrick Walker of MissionWinners.com, a veteran trader with multiple decades under his belt. Pat, thanks so much for coming back on the show. Glad to have you.
Thanks for having me, Richard. I appreciate it. I enjoyed our first time together, and I thank you for reaching out to me. I'm honored that you asked me, and I will do it justice for everybody's sake. Thank you.
Perfect. And I know you will. Perfect. And we covered a little bit about your background in the previous interview, so definitely go ahead and check that out if you haven't yet. It'll be linked down below in the description. But I'd love to kick things off with a little bit about kind of some early struggles that you went through as a trader, because I'm sure a lot of people are just 2-3 years into this and going through a lot of the stuff that you went through decades ago. And later on in the interview, we'll get into some money management, selling rules, all of that. So stick around until then. But Pat, to start things off, what are some early mistakes you made and problems you had when it comes to trading?
It's a great question. First off, I'll back up and tell you this. When I started, there were no computers. Okay, It was, and you can say, Pat, you're old. Don't talk about that, folks. No, there was nothing like that out there. There was no internet. I had to learn by going to the library and grabbing the Wall Street Journal. This was before Investors Daily existed.
Yeah.
Grabbing the Wall Street Journal and getting stock quotes, and I would have pieces of graph paper all over the table in the library. People must have looked at me like a nut, and I would draw charts by hand. And it was very tedious, but I got to tell you, it did something for me. It really helps me understand the nuances of the chart because I'm drawing it bar by bar, putting it all in there. So that really helped me. Was it challenging? Yes, but it sped up my learning curve in truly understanding price and volume relationships and just see what's going on with it. By the way, I'll share this with all of you. Something I'd encourage you to do, don't gloss over the charts. Really study them. Study the price and the volume. And when I say price, study the open, the high, the low, the close, and volume. And here's why. A lot of people just look and say, oh, it's a green bar. Well, here's a green bar. It's like, oh, this is great. But if it closes in the bottom half of its range, it tells us that it was met with selling, not buying. There are nuances in the charts that you can see. Now, I just use simple price bar charts. Okay, I don't use candlesticks. They're fine. But I found this works out really well for me. I know I got off on a little tangent here, Richard, but I think it's appropriate to talk about
Absolutely.
What to do here, You want me to talk a little bit about the challenge that went with all that here?
Yeah, absolutely.
Okay. I was a loner with all this. There was nobody else out there. And I still remember one of the first investing books I read was a book by Martin Zweig, Winning on Wall Street. And I read that book and I didn't just read it, I studied it, which leads a point for all of you. Please, this is serious business. This isn't like, oh, I think I'll try this. Banish that thought process. This isn't a case of trying. It's like going to a doctor. I think I'll try that surgery. What? No, this is serious. So approach it that way. Study it. So I read Martin Zweig's book, which was a great book. And I still remember this. He was on Wall Street Week, the week before the crash, and predicted that there could be a crash coming. And he was a very humble man, very thoughtful. I'd almost call him pensive, humble man. And I had managed accounts, quite a few managed accounts. And I was seeing from his studying, looking at the charts, and this is where it really all started for me, folks. I could see the price and volume as stocks started to fall before the crash of 87. Okay. Mm-hmm. Oh, and to put it in perspective, I just have to say, oh, that must have been pretty bad. No, put it in perspective for today. If we were going to have a crash like 1987, we'd have to fall well over 6,000 points in a day. That was the crash of 87, folks. It was wicked. All right. By following his rules, and this is before I'd read William O'Neill's book, and noticing and having stops in on all my managed accounts, I would get stopped out of a stock. And here's a lesson for all of you. This is where this is going. Let's suppose you've got a portfolio of 10 stocks and you've got stops in on all of them. And you look and all of a sudden you go, oh, I got a sell stop and I got filled on a stock. Oh, wow, that's interesting. And an hour later, you get filled on another one. And the next day you get filled on a couple more. What's it telling you? Don't buy. Something's wrong. So I had stops in on all my managed accounts. we were completely stopped out of everything. We were flat about a week and a half before the crash of 87. And I credit Martin Zweig for that, from putting stops in and controlling risk. The moral of the story for all of you is control risk. I'm not trying to harp on it so much. Protect your capital. And there's two types of capital. And I've got a degree in psychology also. There's physical capital and there's mental capital. And I just have to share this. It's really important. Protect both of them. Protect both of them. I never forget, I had a renowned doctor call me up and he was crying after the crash. How much did we lose? How much did we lose? And I said, we've been out for a week and a half. We didn't lose. And again, it's not because I'm so good. It's not that. I credit Martin Zweig. And I'm honored to have met him a couple of times and talked with him one-on-one. He's really a kind man, a thoughtful man. He passed away a long time ago, but it's a good book to read. Good book to read just for grounding and things like that in the bigger picture. Anyway, that was a big challenge there, trying to figure it all out. And can I run a little further with that? Is that okay with you?
Absolutely. Absolutely.
Okay. So I'm working in a brokerage company in the financial district in St. Louis. And a good friend of mine comes up to me and he said, hey, have you ever heard of Bill O'Neill? No. He said, oh, man, I got to tell you, Pat, you got to read this book, How to Make Money in Stocks. And I'm like, really? And so I said, okay. So I went out and I buy the book. And it just really opened up my eyes to Zweig's looking at the big picture, Dr. Zweig, and William O'Neill is nuts and bolts in it, looking at fundamentals and technicals.
Right.
And I just soaked it up. It was like this, now it's starting to make sense. It's gelling on why things happen. Why are institutions buying a stock? Why are institutions buying Google? Why are institutions buying Tesla or whatever? Okay. Why? And I started gelling it and seeing it. And folks, this is a big foundation for all of you. Price and volume combined with fundamentals. Fundamentals. Years ago, I taught statistics on a university level, so I'm a big numbers guy. But you don't need to be fancy in statistics to know this. Just knowing that the vast majority of stocks, 80% of the stocks that make huge moves have earnings up 40% or higher, or sales up 40% or higher. The vast majority of stocks that make really good moves come from the top 40 industry groups. Why look other places? The vast majority of stocks that are hitting new highs are near 52-week highs. I combine all those variables together, and it's not fancy. I put them all together, and it helps me focus on the stocks that can really make me money and make my clients money. But also, it keeps me away from the junk. So I'm going to share this with you. I'd encourage you, read Martin Zweig's book, okay, Winning on Wall Street. Read Bill O'Neill's book, How to Make Money in Stocks, all right? Those are two great books. I'd also say this, read Mark Minervini's book, Trading Like a Stock Market Wizard. This is a great book. He actually reached out to me and asked me to do a review on one of his other books. It's a good book. It will help you. And people say, oh, Mark, he's your competition. No, I'm not going to get into that. Everybody's here to help people. That's what they're trying to do. That's what I'm trying to do. That's what they're trying to do. And so it will make you better. Another point I have to share with you, though, is please don't read these books like a novel. Read them and study them like a college textbook. Take notes. Take notes. And there's a reason why. We're talking about your money. Right. This is serious. So I just got to share that with you. I know I went off on a little bit of tangent there, Richard, but I think it's things that I always sit there and say, what do I wish somebody would have told me?
Right.
And those are the things. And the last point I'll make related to that, I wish somebody had told me a long time ago, and it really did help me before the crash of 87, because I was running money. Limit losses. Always limit losses. Never argue with price, and never average down. You're wrong. Don't make yourself more wrong. I'm being really serious. If you've ever had a stock where you're down, a couple hundred points, you'll know it eats you up alive. I'll say it again. Two types of capital in the market: financial capital and mental or emotional capital. Protect both of them.
Yeah.
You'll be in this for the long haul. It will help you. And then, what was it? I think Reminiscent of a Stock Operator, where two old guys are talking to each other, and one says, "Gosh, I'm losing sleep over my stocks," and the other guy says, "Sell down to your sleep point. If you're losing sleep over your stocks, you're doing something wrong. Don't do that to yourself. Control the risk, and it'll work." Anyway, I apologize if I went off on a tangent there, but it's a great question to start with, and a lot of material to be covered in that. So thank you.
No, absolutely. That answer was fantastic. And going back to your meeting with Martin Zweig, I'd love to hear more about any stories you can share from that meeting, as well as I know you also talked with Ed Seykota and O'Neill in person. So I'd love to hear about those interactions and any kind of words of wisdom that they passed on to you.
Sure. I'll start with Zweig, Dr. Zweig first. We met him, and he was at a conference, and I said, "What the heck? I'm going to go up and talk with him." And I think a lot of people were afraid to. What's he going to do? Say, "No, I don't want to talk to you." Okay. My philosophy is this, folks. You're already at zero. Why don't you take the shot and try to reach out to somebody? Really, you have nothing to lose and everything to gain. So he was there, and people were afraid. So I went up and talked to him, and I shook his hand, and I said, "Dr. Zweig, it's a pleasure meeting you. And I just wanted to thank you so much for your work that you've done and the information that you provided us on Wall Street Week. And because I followed your lead, watching what interest rates were doing, but watching the deterioration in the stocks, I had stops in, and I was completely out before the crash of '87. And he says, he's really pensive. He was like, "Oh, that's very good. That's good to hear." And I said, "Yeah." I said, it's wonderful. Your big foundations, the big fundamental foundations, not as much technical, but fundamental foundations really helped me and made me steer clear of the crash. Oh, well, that's good. I'm glad to hear that. So we talked a little bit more. I couldn't talk to him a lot. I got to be very honest, folks. Why? Because he's a star. Everybody wants to talk to the guy, especially after the crash of '87. So I wasn't going to monopolize my time with him. So that was it. Well, then back, I guess it would have been probably 1997, 98, something like that. I think that's about right. Ed Seykota was appearing and talking at a technical conference in San Francisco. So I said, "Well, a buddy of mine lived out there." He said, "Why don't you fly on out? We'll go see Ed. Meet Ed Seykota." I thought, "Yeah, sure. I'm sure we're going to meet him." Yeah, right. So Ed Seykota gave a wonderful talk. I have to share this with everybody. If you don't know who Ed Seykota is, it's Seykota. Google him. Buy the book Market Wizards. Don't just read it, study it. I actually met Jack Schwager also, who's a nice guy. Nice, really nice. All these people are humble. They're not like, "Hi, and my." They're just real folks. So after the conference, Ed Seykota was talking. Now, he's primarily a commodities trader. And you read the returns, I think they're 100,000% in his managed accounts. That's not too bad, all right? He's an MIT graduate, so he's pretty sharp. So I went up and I said, "Mr. Seykota, thank you for the lecture that you gave us." And I said, "I've got a question for you." I said, "I know that you use the 5-period exponential moving average. I've studied that, and I'm using the 10 with stocks, and I wanted to get some input on that. I found that works very well." And I'll never forget this. He's wearing bifocals. He tilts his head back like this. He goes, "Why do you think that is?" And this was the intriguing part of the conversation. Almost every time I said something, he'd go, "Why do you think that is?" And we would talk about it. We got down to it as far as money management and riding trends. And he really challenged me. I mean, I got to tell you this. He really challenged me to look at different time frames as far as to make decisions. What time frame is best for commodities? What time frame is best for stocks? So he uses the 5-period exponential moving average. All right. Well, I thought, you know what? If it's good enough for him, I'm going to use it. Right. So I started using the 5-period exponential moving average on stocks. And man, I'm getting whipped around and all this other stuff. It's like, this ain't working. Well, I had a good buddy of mine, actually 2 good friends, and I'm not going to mention their names because I don't want to do that. I don't even mention first names. But we did a deep dive, a really deep dive on the 10 period simple, the 5 period exponential, and we started looking at hybrids, and we started looking at the 8 period exponential moving average. Now, folks, I'm going way back before people were talking about any of this stuff. Okay. I mean, this was before the internet. All right. And we would study it and we would talk all the time. In fact, I know this on this conversation we'll have right now. My good buddy, who is he's a brother from another mother. That's it. And he knows who he is, and I ain't going to use the name. Anyway, he's the best options trader I've ever seen in my life. The guy prints money. He's scary good. But we started working on the 10 period simple on charts. Then we switched to the 5 period simple. And we would go back and forth. We tested the 6 period simple and the 6 period exponential. You could say, well, how long did this take? A couple of weeks? Heck, no, we were working this for over a year, studying it, testing it, real time with what was happening. And finally, and I'm going all the way back, folks, to the last century. You go, man, you're old. Don't bring that up. We came up to Richard's smile, and there you go. We figured it out. The best moving average, and this is before anybody else talked about it, was the 8 period exponential moving average. Not the simple, the 8 period exponential moving average. The 5 period exponentials, too fast. The 10 period simples, too slow. We found the 8 period was good for up close when you're buying it. And then after it works, you go to longer term time frames, the 21 period exponential and the 50 period simple, and let them trend. But the 8 period exponential worked and works really well for us. And it has for this century, to tell you. And you can say, Pat, you're old. Don't talk about that. That hurts. Anyway, that was wonderful to do this, to get the springboard with Ed Seykota, and build off of it. And again, I think the 5 period exponential is great for commodities, but for stocks, it's too close, way too close. So there's a hybrid. I know that was a long story, but there was a couple of years of work in doing this every day. And you could say, Pat, why were you so driven? For those that don't know, my dad, who I was very close with, died, when I was 26 years old. And I still remember it because that anniversary was 2 weeks ago. And we were very close. Well, he owned a hardware store in St. Louis, and he died. And my mom, who was not really interested in the business, sold the business. And she gave me the proceeds from the sale of that business to invest. And folks, she's widowed. I realized I have got to get serious about this. I can't lose her money. I can't. So I really had to jump up overdrive to make it happen. And I'm sure that many of you that are listening to this right now may have a similar situation where you're like, yeah, man, I'm supporting a family and this is killing me. Yeah, that's one of the biggest reasons I started Mission Winners, is to help other people, is to jumpstart the process, speed it up so the trial and error can be bypassed to a degree. So anyway, that was a long story, but it was great meeting him. And then should I tell you about Bill O'Neill?
Of course, absolutely.
Let's rock and roll. I'm kind of shy here, so this is helping me get over my shyness, Richard. I appreciate this. It's like therapy for me. And everybody that knows me goes, nah, you're just crazy, Pat. Anyway, Bill O'Neill. So I had a really good friend who worked for O'Neill and Company in California, and I can't mention her name, okay? And she said, hey, Bill O'Neill's giving a level 3 conference up in Chicago. Would you like to go? And I said, sure. She said, well, we'll get you in. So flew up to Chicago, and there's Bill O'Neill. And got to talking to him. And that first meeting, I think it was just Bill O'Neill, and listened to him. It wasn't CanSlim level 3 or 4. It was, it was the basics when he was going around. But it was really a great, great conference. So what did I start doing? I started getting the Daily Graphs books online. Okay. Before they were online, though, I used to have them mailed to me. And some of you are going to smile as I say this: the green book and the blue book. Many people will say, I don't know what the heck he's talking about. If you were involved with Daily Graphs, you know what I mean. A long time ago, those books got delivered to me on Sundays, and then I would go through them. But it was really great because afterwards I got a chance to go up, and I said, nobody's going to. They're all afraid. What the heck? I'll go talk to him. So I got up and I went up and I just talked to Bill O'Neill. And he's another man very pleasant, very driven, very focused, very motivated, but just a nice guy to talk to. That's something I found is they're not arrogant. They're humans. They're just fellow humans. And I thanked him for his work and what he's doing and how he helped me. And again, I'm handling money, and not just my mom, but a lot of people's money. And he really helped me. So a suggestion, how to make money in stocks, mandatory reading, mandatory reading. Well, then I guess it was about 2 years later, Bill O'Neill is giving a level 3 conference down in Houston. And so my friend said, hey, would you like to go? I said, sure. She goes, well, I'll get you in. So, and again, no names. So I got to go there. And it's really comical because we're in a really nice hotel in Houston. And I tell my wife, I said, I'm going to go to the conference now. I'll see you later. She goes, okay. So I walk down the hallway and I get on the elevator and there's 2 guys standing there. Okay. And, everybody, when you're on an elevator, you kind of like don't violate anybody's space, right? I get on the elevator and what's everybody always, you all are going to smile. What do people do? They always look at the numbers. What floor, So I pushed the button. I thought, what the heck? I'll turn around. And who is it? It's Bill O'Neill and David Ryan. And I'm like, wow. So I said, and he says, hey, I remember you, and maybe he didn't. Okay. I remember you, so we shook hands and I got to talk. So on the elevator ride down, I got to talk to both of them. And it was just a really polite conversation. It wasn't like, we're so good. Just 2 great guys that are doing this to help other people. And it was nice. And then later on, Bill's sitting there eating lunch. And I think everybody was afraid to go up there. So what the heck? I went up and just sat next to him. We had a nice talk and ate some lunch together. And I think the best part is he put up with me. But it was great. I learned a lot from Bill O'Neill. I continue. I learned a lot from David Ryan also. David Ryan is an excellent stock picker, a very humble man, but a man who's willing to share. So anyway, those are just a couple, maybe I went a little long, but it was really cool meeting some of those people. And again, Ed Seykota, why do you think that is? Constantly challenging me. So this is my challenge to you, for all of you. When you reach a conclusion on something, question it and ask yourself, why do you think that is? Understand that, grasp that concept when you're looking at the charts. Why do they do what they do? It'll really help you. It'll help you. And everything I just shared with you, I wish somebody would have told me years ago. But we're doing it now, and that's a good thing.
Absolutely. And Pat, I'd love to hear if there are any specific turning points within your career and performance, any rules that you kind of incorporate into your system that really made a significant difference, going maybe from 10% a year to 30, 40% a year performance, that type of thing.
Exactly. Great question. And folks, I have to tell you, I was a sole supporter of a family of 6. And I was helping to support my mom too, helping her out on top of it. So it was a pressure cooker. And at 4 kids in private Christian schools at the same time, you're talking 15, 20,000 a month going out of the account, cash. So guess what? I had to make it happen. So when you have that kind of pressure, it clouds your judgment. So I'm going to share something with all of you that will help you. A lot of people say you'll never go broke taking a profit. And that's a lie. That's an outright lie. If your losses are bigger than your profits, you'll go broke. So being in the pressure cooker, I would buy a stock, okay, and it would go up in price. I'm like, yes, I'm up 5 points. Yes, let's sell it. Let's make that money. I had to make that money. And I did. And it would go up 7 points and 8 points and 10 points and 15 and 20. And I could never find a way to get back in it. It drove me nuts. And as I'm saying this, I know people are smiling going, man, I know right where he's coming from. That just is bad tuna. And it is. So I realized I've got to change something here. I cannot limit my profits. I have to limit my losses, but I can't limit my profits. So I worked really hard on it with a friend of mine who, again, I'm not going to mention his name because some of you would know it. Anyway, we worked really hard and we realized, what do we need to do? And this is for all of you. Limit losses. A clean and simple base entry will give you a clean and simple exit for a much smaller loss. Sell some, and this is a major foundation of mine. After a stock's made a decent move, sell 20% of it. One of my degrees is in psychology, and the biggest part of investing is what's up here. It's between our ears. And Richard, I know you know what I mean. I mean, it's a head game. Mm-hmm. There's a stress level associated with it. And high stress and good decision-making are mutually exclusive. So what did I find? I'll sell just 20% for a profit. By so doing, think about this, folks. Mentally, psychologically, what has that done for me? I know that I'm going to make a profit. I am guaranteed profits. The rest of my shares could fall to my buy price and I sell them for break even, but I still made money. No matter what happens, I'll make money. Now think about this from a pragmatic perspective. By so doing that and accepting that fact, that reality, it completely relieves stress and pressure. And when you've eliminated or minimized stress and pressure, it leads to clearer thought processes and clearer decision-making processes. It does something else for you. By minimizing that stress and knowing that that stock could fall to your buy price and you sell the rest for break even, knowing that you're going to make money from a psychological perspective, you know what it does? It allows you to let shares work much, much longer. Trend, which leads to the other point. Going back to it, the 8-period exponential moving average makes all the difference in the world. Let it ride. As long as it keeps riding, take it down to the 21-day exponential after it's really pushed. Take it to the 50-day simple. I'll share this with you. And this is the honest to goodness truth. I've had stocks, I don't even have them on my front page. I've got a price alert set, but I don't even look at them. I'll look at them maybe once a day. Don't undermine your efforts, okay? Don't sabotage yourself, all right? I can't stress that enough. Anyway, it was a pressure situation, and I found that evolution of saying, I'm defeating myself. Don't sell too soon. Let some shares ride. Knowing I've sold some and guaranteed that profit, I can let it work. Let it work. And then here's the other beautiful thing. So let's suppose it goes up, and then it kind of goes sideways for a while, and it breaks out. You buy more shares. You keep buying, okay? Let it ride. But remember this, rules of proper pyramiding, and this is important. If you own X number of shares and it breaks out again, always make sure that your secondary purchases are less than X. Never, if you own 100 shares, never buy 100 more shares. You're pulling your average price up too high. Rules of proper pyramiding will really, really help you. And if you've read other books, you'll know what I'm talking about. CANSIM level 3 and 4, and I've been there. Okay, I've got their manuals in here, and they really helped me. Credit where credit's due. Bill O'Neill really helps me. I'll tell you that right now. By the way, the other guy was there in Chicago. Man, he was all clean cut and everything like this. Had a 3-piece suit on. Got to talk to Mike Webster was there. And so shout out to Mike. He's a great guy. And I still remember that. That was a long time ago. I mean, you know how far back that was? I had hair back then, okay? So we're going way back when, all right? But anyway, I got off on a tangent there. Ride them for all they're worth. I can't stress that enough. Never average up too much. Mm-hmm. Rules of proper pyramiding. In CANSIM level 3, and this related, you know, when Mike Webster and Bill O'Neill were there, CANSIM level 3 and 4. Here's the hard and fast nuts and bolts for you. Your goal is to get to 100 shares of a stock. It breaks out. Your first purchase is 50 shares. The stock goes up 2-3%. Your next purchase, if it goes up, 30 more shares. Continues going up another 2-3%. Your next purchase, 20 shares. 50, 30, 20. By so doing, you'll never have a problem. Also remember, if it doesn't go up in price, you've only bought the 50 shares. You didn't add to it. That's a great tactic. I credit Bill O'Neill for that. The man changed my life. Give credit where credit's due. He's one of my heroes and a nice guy too. Anyway, I stress that. Rules of proper pyramiding. So I'm going to say it again. Your goal is to get, we'll use the number of 100 shares. Okay. If you want to make it 1,000, transpose the number. but just for the simplicity's sake, you want to own 100 shares of Apple. All right. Your first purchase would be 50 shares, breaking out. And always remember, it's breaking out of a clean and simple base. Remind me to talk more about that if you want, Richard.
Absolutely.
You know that phrase, right, buddy? You've heard it a couple of times.
Yep.
Your first purchase, it's breaking out of a clean and simple base that everybody can see. I'm going to pause here and you can say, Pat, why clean and simple base? Think about this, folks. We want other people to see what we see. It increases the odds that they will buy also. So focus on clean and simple bases that a fifth grader could look at and say, oh, it looks pretty good. I could draw that with a crayon. And if it goes across the tops and volumes, I guess I could buy it. Don't you want other people to see it? That's something in Mission Winners I talk about all the time. I want everybody to see what we see. Nothing fancy. Why? Again, pragmatically. If other people see it, man, it increases the odds they're going to buy too, right? Isn't that what we want? I want other people to buy. All right. So again, clean and simple base. First purchase is 50 shares. Second, it continues to go up in price. Next purchase is 30 shares. Continues going up in price. The next purchase is 20 shares. And after I've said that, I'll also always temper it with this statement. Please, never let a good profit turn into a loss. And I'm not talking, oh, I'm up 20 cents. No, never let a good profit turn into a loss. Leading into that also, I'd encourage you, stay away from low price stocks. I really don't like buying stocks over 10 or 12 bucks a share. Under, 20.
Under, yeah.
Yeah, you got that. And also, I don't like buying stocks that are thin. Okay. Stocks that are thin. And you can say, Patrick, what do you mean? Stocks that trade like 30,000 shares a day, 50,000 shares a day, they can go up fast, but they can drop like a rock. Beware of that. I want to find things that are fluid where I can glide in and I can glide out and know that I can get out without a problem. And that'll help you. And I'll say it again. And again, Richard, thanks for having me. Everything I'm sharing with you folks, this is the honest to goodness truth, are things that I wish somebody had shared with me years ago, but there was nobody out there. So I appreciate you having me do this, Richard. I really do. I like your work and what you share with people. So thank you for having me.
Of course, my pleasure. And obviously, you've been doing this for multiple decades, and I love to lean into your experience here and hear your thoughts on going through difficult corrective periods where, it's like 87, 2000, 2008, and the recent action as well in the current stock market. I love to hear your guidance for new traders who maybe haven't been through a big correction like this, as to how to handle it, how to identify it in the first place, and how to keep that mental capital strong as well, because that's so important.
You got it. Great. This is a great question. You should do more of these things. This is awesome. No, there's two types of capital in the market, and Richard touched base on it. There's financial capital and there's mental or emotional capital. And folks, you got to really protect both of them. If you get beat up, it leads to what's called the freeze. Jack Schwager's book, Market Wizards, Interviews with Top Traders, is a great, great book. I encourage you to read it. I encourage you to study it. Especially the last chapter is an interview with Dr. Van Tharp, T-H-A-R-P, where he goes in and analyzes from a psychological perspective things that we can do to protect ourselves psychologically, which also will protect us financially. Mm-hmm. And also remember this, never argue with price, okay? Forecasts don't pay, opinions don't pay, analysts don't pay, newsletters don't pay. Nothing pays, price pays. Focus on that. When you start going through a really rough time, when the market gets kind of squirrely or bad, I'm keeping it clean, one of the best things we can do is this. And I had a wise old broker who had a relation on Wall Street Week. So we kind of got wrapped up with Wall Street Week. Don't argue with price, get livable. And that's what he would tell me this. He says, get livable. Pare it back, and continue paring it back. Never try to get even. Never try to get back at a stock. Never average down. Mm-hmm. I'm going to say this again. Never average down. Please, I'm asking you, You are wrong. Don't get more wrong. And you can say, well, yeah, it could come back up. And I said, yes. But if it continues dropping, it will eat you up alive. I can't stress that enough. So it's very, very important that we control ourselves financially and psychologically. So let's talk, Richard brings this up. Let's talk about right now. You know, the market's gotten pretty rocky here recently, correct?
Yeah. Do you want to bring up your screen, Pat, by the way?
Yeah, sure. Let's do it. So here we go. We're taking a look at the spiders. Now I've got to share something with you. I'm going to go on a tangent for you, okay? Years ago, I had a serious eye problem, and I actually had a surgery, and I went blind for about 2 hours. So it was a bad situation. I still remember it. They had to hold me down on the table. Anyway, this is the point here, folks. Protect your eyes. All right. I really mean, you can, what the heck's that got to do with stocks or investing? It's got everything, because if you can't see, you're going to have a problem, right? So we're looking at a chart here of the spiders. And if you noticed, I'll just share this with you. Notice I have a black background, and I have bright green, bright red. You see this?
Mm-hmm.
Moving averages corresponding on the volume bars. Here's what I found through the years. This is much easier on your eyes. I'm not telling you to use these colors, okay? But I've studied a lot of different colors. I mean, a lot. And I found that with the black background, the high resolution makes it much easier to see the colors. So I know I went off on a tangent there, but I just want to help people. You know, and it's something I wish somebody had said to me, hey, Pat, you know what, these pale gray colors you're using on background, man, it's eating up your eyes. Don't do that. This is sharp. This is crisp. Isn't that what we want? Now, I'm going to enlarge this a bit. We'll go through this real quick. If it's all right with you, then we're going to talk about the drawdown here, if that's good with
Absolutely.
you.
Yeah.
Green bars are up. And notice the volume bars correspond to the price bars. Red is down. I use price bars with an open, high, low, close. If you use candlesticks, that's fine. Find what fits you. This fits me. It's what I've used for decades, and it works. And there's a great lesson here. Don't think that just because it's a red bar, like this bar right here, most people would look at this, and I'm going to enlarge this for you. Most people look at this and say, that's a bad bar. It's a red bar on heavy volume. Note, and this is something I teach all the time at Mission Winners, study the open, high, low, close. Look at this bar. It gaps down. See the open? It drops and reverses and closes near the highs on a pickup in volume. Folks, they bought it. They didn't sell it. They bought it. Right here. Oh, this is a red bar on pretty heavy volume. Note the open. Note the close. It falls down and reverses and closes near the highs on pretty good volume. Folks, they bought it. They didn't sell it. So don't think that just because it's a red bar, it's a bad bar. At the same time, don't think that just because it's a green bar, it's a good bar. Analyze the price and volume. And I need to tell you all something. This isn't rocket science. This is simple. Just green bar, red bar, and corresponding volume. And study them. All of a sudden, I will tell you this, honest to goodness, it will start gelling for you, and you'll say, man, this is awesome. Now let's take it a step further. Richard had a good point about like what's going on now. Here's this run, okay? This drop. This is the kind of stuff that can chew you up alive, folks. Don't argue with it. Starts to lose the move. Remember we talked earlier about, hey, watch out if it starts to lose the moving averages, especially the 50-day. Yeah, look at this. This bar right here, you could have gotten out there if you wanted to. And no, there's no day trading. I need to tell you all this. I haven't looked at a 5-minute chart, really studied a 5-minute chart in years. I don't look at them. There's too much emotion in it. Now, if you use them and they work for you, that's fine. I'm looking for bigger picture moves. But watch this. It falls down hard, and watch this bar. It gaps down, right? Big gap down. No, I'll make it a bigger. Is that a little bit better? See, Richard? Is that good?
Yeah.
All right,
that's
good deal. Thank you, sir. Closes here. Heavy volume. The next day, gaps down. See that gap down? Runs and closes up near the highs on heavy volume. resistance overhead at the 200 day. Okay. Be real careful with a big tail bar like this. All right. Especially after a longer move. That's tougher to deal with. It's riskier. In fact, again, I taught statistics on a university level. This bar has a less likelihood or a lower probability of working than letting it base for a little bit and forming a higher low. So watch this. It drops down. People say, I'm buying on that bar. This is it. It's washed out. Yeah, and it gaps down the next day and you go, good Lord, what happened to me? Oh, and the next day it gaps up, runs up and reverses and closes down on heavier volume than the previous bar. It's just chopping around. This stuff right here will chew you up. When you see this, just stop. Don't do anything. Wait. Just because the market's open for business doesn't mean you have to do business. It's that simple. So what do we do with this? This bar right here, quieter bar, gaps up, drops down, runs up, and reverses and closes near the highs. And I'm going to make this bigger for you. See that bar right there? On a pickup in volume. This is one of the simplest setups that I'll use. Okay. Now this isn't as simple as a clean and simple flat base. So know this. This is more advanced than that, but it's a higher low. This low is higher than this low. It's that simple. And we're buying. As it was thrusting up through this bar, we're buying here. Okay. Which did we use? I'll tell you. We did this right in here with SSO. When it started doing it, we were picking it up on this bar right in here. We had 4 buys in here as it started to lift, and it works. It doesn't work every time, but it works more times than not. And it's simple. Conceptually, it's simple. It's a higher low. This low is higher than this low. Now watch this. Right here. It's going back. Shrink this a bit. It's dropping, and you're just getting chewed up, okay? And it keeps dropping, and then it falls, and it bounces around. Note this. It runs up. It pulls back on less volume than these selling bars. And on this bar, it drops and closes near the highs on less volume, but still decent volume. But more importantly, it has a higher low. This low is higher than this low. Right there, you see it? This low is higher than this low. And on this bar, we were buying. And it lifted. Does it work every time? Nothing works every time. But this is a great strategy tactic that we use. I'm going to show you another one. I want to drive home the point on the higher low. Is that okay with you, Richard? Can we do that?
That's absolutely fine. Absolutely fine.
This is the real world setup. This isn't hypothetical stuff, folks. By the way, yeah, we owned this. Okay, here we go. NVIDIA. You can say this right here. Look, this is a higher low setup. You see this? And this was on the list. And some of our VIPs bought it. This low is higher than this low. Starts to lift, they pick some up. And that's a decent move. But watch this. Now that you've trained your eyes, it's doing this. And now I'll pause here because Richard asked this question. What do you do when the markets are crummy? You sit and you wait. You simply wait. Don't let this turn into a video slot machine. Please never think that you've got to do something all the time. You don't. You don't. Wait for the high probability pitch and swing. All right. It's much better than saying, oh, I'll just try. Wait for things to line up and the money follows, especially if we focus on a couple clean and simple patterns. Look at this. It's dropping and it's loose and it's whipping around. My gosh. And it drops to here. All right. Looks like dirt. And then it rallies, comes up to the 50-day, and it pulls back. And notice this. It lifted on pretty good volume here, and it pulled back on less volume. So we say, okay, this low is higher than this low. But until it triggers, we'll just have to wait and see what happens. Okay, it's just an inside bar. Increasing volume, though, that's a slight telltale sign. Doesn't mean to buy it yet. You need to take out the bars high, but it's a start. Okay. Oh, look, it gaps up and it goes and it pushes through the 21-day and the 50-day, and it does it on a pickup in volume. On this bar right in here, and by the way, this was on the key list. VIPs knew about it and they bought. They bought right in here a couple of times, and it does this. Now watch. That's the 8-period exponential moving average. And it just goes, and it goes, and it goes. You're selling some up here, by the way, okay? And by the way, I will share this. I'll never buy at the bottom, and I'll never sell at the top. You know who does that a lot? Liars. I don't know what the top is on that. Get what you can. But from right in here, we'll call it 215. Right in here, 215 up to here. I mean, folks, that's dang near 100 points. There you go. And what is it? It's the simple higher low pattern. There we go. Ride it for all it's worth. And when it finally rolls over, you're out of the rest and you say goodbye. And it works. It works. Anyway, I wanted to point that out to you. That is a great real world setup. They talk a lot about the cup and handle formation. I love cup and handles. You know what else I love? Clean and simple flat bases that everybody can see. Why? It increases the potential that they'll buy also. Focus on those and you'll do much better. It's what we look for. So while I'm talking about, if it's okay with you, Richard?
Go for it.
Can I talk about just the basis for a minute?
Absolutely.
Okay, very good. I'd like to show you a couple things here, folks, just to drive home the point right here. Apple, chopping around a little bit, but look back here. You see the base? You see the volume pickup? A fifth grader could look at this. Even me could look at this and say, hey, look at that's not too bad. Focus on those and you'll do much better. Here you go. Apache lifted through here and it ran up and then it reversed. Okay. But what do we do in the situations like this, folks? You heard me say it earlier. You can't catch me in a lie. You sell some into strength, especially when you get a big gap up and it reverses down, you sell some. But note the clean and simple base. It works. Here you go. DAC. Clean and simple base here. Runs up, reverses. You're going to sell some on that, okay? Drops down. Remember, the market's squirrely. But note the longer clean and simple base. And it lifts off. Look at the volume here. Again, it's like, oh, it's going sideways. I guess if it takes out that white line, that wouldn't be bad. Oh, gee, it does on a pickup in volume. I guess we should buy through the white line. Yeah. Vanilla. Focus on this. EOG right there. Simple entry. I want to do something here. I think it's important. By the way, again, one of my backgrounds is in psychology. And so if we always look at everything after the fact, we get this mindset that, oh, this is easy. You know what's a better thing to do, folks? Slide the chart back and train your eyes. You can say, oh, okay, it's going sideways. It's just I could draw that with a crayon. Probably best not to do on your monitors. And it's just going sideways here. Oh, gee, look at that. Gosh, it picked up through the 50-day. By the way, all these are in leading groups. Every one of these were in leading groups. Look at the volume pickup. Gosh, I guess if it takes out that line, that'd be pretty good. Oh, gee whiz, it does. Look at that. And it's off. There we go. From here to there. That's it. It's vanilla. Halliburton. Base right here and a little shelf right here. And look at the volume pickup. Everybody saw this, folks. It's like, oh, look at that bar. Gosh, I guess if it takes out that white line, that'd be pretty good. By the way, yeah, we own these, okay? Oh, there it is. Over and over. Focus on those and you will do much better. And again, why? Because everybody can see them. I can't stress that enough. Now I want to draw back here just a minute. All these stocks I'm showing you, all of them are in leading groups. Leading groups. Focus on this. I'm going to make this I'm going to pull this together real quick. Focus on stocks in the top 40 or 50 groups out of 197. This is Bill O'Neill stuff. For those that don't know, yes, I was an IBD meetup co-leader for 12 years, and I talked about this on the big stage every month. And nobody heckled me either. I had a couple things thrown at me, but I missed it, so it was no big deal, right? It was good, keeps me limber. Anyway, but the sharp objects, tough deal. No, focus on clean and simple bases that everybody can see. Focus on stocks that are in leading groups. I've got research in here. I'd show this to you. This is crazy. I don't know if you can see it. I mean, folks, hold that up really close. This is from 2011, okay? But it talks about, I have to read this to you. if this is okay. You don't mind if I do that real quick, Richard?
Go for it. Go for it.
Not the whole article. I won't do that, okay? Here we go. Talks about the markets doing well. The degree of success in the markets is directly related to the adherence to sound buy rules. Let's look at some cases. Folks, I'd like you to really dwell on this. From August 2007 through October 2007, the market was in a confirmed rally. IBD identified 39 breakouts. Investors Daily identified 39 breakouts in the paper, okay? Each offered a valid buy point or buy range and had big volume through the pivot at the breakout. The composite rating of all these was 88 or higher. There's a constraint for you. The paper's giving it to you. Know this too. I don't work for the paper or for O'Neill and Company, nothing like that. I'm being strictly objective with everything I say, everything I share. But this is important. I said before, the composite rating was 88 or better. Here's how the 39 stocks did. The top performing tier, and this is power for you. 39 stocks broke out that IBD identified. 10 stocks did roughly 4 to 10 times better than the NASDAQ's advance. 4 to 10 times better. Isn't that what you want? That's what I want. 4 to 10 times better than the NASDAQ's 11.5% gain. All of them had a composite rating of at least 96. See, now there's an edge that you can use. You can say, you know what I'm going to start doing? I'm not going to look at stocks that got low composite ratings. You're stacking the deck in your favor. All of them had a composite rating of at least 96. 8 dwelled within the top 30 groups. 8 of them were in the top 30 groups. The other 2 were in groups 41 and 53. What's that tell you? I just gave you numbers, a statistical edge on what to look for. The second tier, I want to touch base on this. Is that okay with you, Richard? Are we cool?
Absolutely. Go for it.
Okay, very good. Thank you. The second tier, 9 stocks did roughly 2 to 3 times better than the NASDAQ's gain. Would you be happy? Oh, the market was up 10%. How did you? The worst I did was I was up 20% to 30%. Yeah, you know. Isn't that what you want? There's the edge that we use, foundations. Here we go. I'm going to say it again. 9 stocks did roughly 2 to 3 times better than the NASDAQ's gain, okay? 7 of the 9 had a composite rating of 97 or higher. And again, I'm a numbers guy, all right? And yeah, I'm wired pretty tight about a lot of different things. For those that don't know, I used to periodically teach outdoor survival skills at higher elevations over 12,000 feet and life and death situation. So yeah, we're wired tight. It was crazy once we were above the lightning. Not a good situation, especially when you can smell it. 7 stocks did roughly that, right? Composite rating 97 or higher. 7 were in groups, industry groups, 30 or higher. I mean, folks, there's the recipe for the cake. I love that. Isn't that what we want? So what's the moral of the story? Leading groups and leading stocks. I've got to share another research, and I've got a ton of my own research here. I'll show you this. Mm-hmm. This is from 2010. I'll hold that up. Mm-hmm. These are all my own notes, and they've helped me develop and refine my foundations of what I look for. Another article. This is from 2008, Investors Daily, 2008. In a study, this is powerful. I want to just share this with you. And again, Richard, I'm glad you asked me to be on your show. I really appreciate it. And I know your goal is to help people. Mine is too. I'd like to share this with you. By the way, I like your work that you do. You present great information in a good fashion that everybody can understand. I'd like you all to listen to this. This is Daily Graph's Investors Daily Research. In a study of the 600 best performing stocks from 1952 to 2001, folks, that's almost 50 years. That is a statistically valid sample size. We're not talking, well, they did really good for 6 months. I'm talking 49, 50 years. Isn't that what you want? Over time. I love this. 3 out of 4, okay, 600 stocks. That's also a statistically valid sample size. 3 out of 4 had earnings increases averaging more than, are you ready? 3 out of 4 of the 600 that made huge moves had earnings up 70% or higher before they broke out. 70%. That's huge power. The 1/4 that didn't showed earnings increases of at least 90% the following quarter. 600 stocks, 600 stocks. And that's what they did. So I just wanted to share that with you, that focus on stocks that have great earnings. This is for everybody. Focus on stocks that have earnings 40% or higher, or average sales for 2 quarters 40% or higher. Focus on stocks with a composite rating of over 90. Focus on stocks that are at least $12 a share, that are within 20% of 52-week highs, that have an accumulation distribution of A or B, and they trade at least 200,000 shares a day. And what I just said to you, if you wrote it down, is $1 million sentence. It will help you. It will really help you. And I'm speaking from my heart. These are things that I wish somebody would have shared with me and said to me years ago and said, hey, give up on all the other oddball stuff. Focus on this. Another point I want to bring up, and I'm sorry if I'm belaboring the points, Richard. I'm not trying to go too much, but just trying to help, just like what you do, trying to help people. Always limit losses. Always. Never argue with price. Clean and simple base. It's good above the line and it's bad below. It just makes it easy. Okay. Focus on those. Focus on volume surges through the pivot. Why? Think about this. Let's be pragmatic. A stock breaks out and there's no volume. It tells us instantly, nobody's acting on it. Don't we want other people acting on it? Take these constraints that I shared with you, focus on those with clean and simple basing patterns, and you'll make money. It works. It works. Does it work every time? No, it doesn't. Even Bill O'Neill would admit it. If everything worked, he'd never have to talk about limiting losses at 7 to 8%, would he? So we're very pragmatic. We control risk. We'll ride trends for all they're worth, but we'll also control risk. And that helps us. And from a fundamental perspective, you now know what to look for. Focus on stocks in the top 40 groups. I'm going to summarize this really quick. Focus on stocks in the top 40 groups that last quarter's earnings were at 40% or higher, or the average sales for 2 quarters was 40% or higher. It's got a composite rating of over 90, and an accumulation distribution of A or B. It's within 20% of 52-week highs, and it's in the top 40 groups. Man, I'm telling you what, that's it. That's it. When it breaks out, look for volume surges in a good market and ride it. Ride it. Sell a little bit into strength, as Richard and I discussed. Sell 20%. It guarantees a profit, but it allows you to let remaining shares work much longer. And if it goes up and then bases and forms another small base and lifts off, buy more shares. That's it. Wash, rinse, repeat. By the way, Richard, I haven't had any caffeine for a long time. Is that pretty cool?
Yeah, absolutely.
So anyway, I know I went deep there, but I wanted to do that to help people. That's important.
Absolutely. And that answer covered a lot. So I thank you for that. And I wanted to ask a specific question on the higher low setup. So maybe if you want to bring up an example, maybe NVIDIA again, I'd love to ask you if where that higher low forms with respect to the moving averages matters for you on that type of setup, since we are in this particular example, we're still below declining 21, declining 8, declining 50. So the trend isn't quite in alignment versus some of the other examples where the base was a little bit more developed, a little bit shallower, and had a little bit more of a, that standard cup shape that's more pleasing to the eye. So I'd love to hear your thoughts on that.
Great question. Perfect question. I love the higher low setup. I prefer it above the 200 day, but there is one caveat that I will quote unquote bend, and it's the max list stocks. On the max list stocks, these are the big institutional darlings. These are stocks that if the managers don't own them, if the funds don't own them, their managers are going to be fired. All right. NVIDIA, it's a franchise. I mean, folks, Apple, if you own a growth mutual fund and you open up the prospectus and they don't own Apple, chances are that manager is going to be fired. Right. By the way, I'm not trying to tell you to buy Apple right now. No, no, no. I'm just talking about big institutional names. Apple, Amazon, Google, all right, NVIDIA. So and I do stress, I'm not telling you to buy any of these stocks now. That's not my point. I'm just talking about big institutional darlings that can provide good buy setups. So we're looking here, and then we're going to get right to Richard's question. This was bouncing off the 200-day. That is acceptable, all right? I would much prefer it off the 50-day, okay, right here, but this bounced off the 200-day, and VIPs bought it. Some VIPs bought it. I didn't buy this setup, okay, but some did, and you can see why. Overall, I would encourage you, focus on stocks that are above a rising 200-day, which this is. Better yet, focus on stocks that are above a rising 200-day and a rising 50-day. Greater odds they're going to work. And can I do something real quick, Richard? Can we just go through the max list stocks real fast? Is that
Absolutely.
cool with you?
Yeah,
all right,
let's
here
go
we
for
go. We'll just show you this. This is something I do every day with the VIP. Well, not every day with the VIPs, but frequently. I'm just going to share this with you. There's the spiders pushing through the 200-day. Notice the higher low here. That was a great trend. Here, it's lifting. It's a little bit more aggressive thing with SSO. This is the one we showed already that worked. QQQ. Note this. This is important. At the 200-day, all this was doing it below the 200-day. It was too risky, didn't do it. But the higher low worked. You can see it. QLD, similar situation. Excuse me. Skip QLD because it's on another problem here, right here. Okay. The higher low setup right there. A couple of people bought it. There we go. Let's contrast it. IWM, lower low. See this?
Yep.
Not going to do it. It's like George Bush. Not going to do it. Okay, here we go. TNA, not going to do it. MDY, lower low, not doing it. This is focuses on the max list stocks, had a higher low, but we didn't do that. All right. This is the inverse. The inverse, we're going to leave it alone. Now we're going to go to the max list. Okay. Here they are. Apple. See that clean and simple base right there, folks? And please know, this isn't a case of Pat Walker bragging. Okay. That's lame. But we're going to look at some of it. Look at the base. Look at the volume pickup. Look at the trend. It's vanilla. And remember this. These are the big names. I'll say it again. If you own a growth mutual fund and they don't own some of these stocks, their managers should be fired. Okay? These are the big Apple. Nobody does what Apple does as good as Apple does it. By the way, please don't think I'm telling you to buy it now. I'm not. I'm just talking about the bigger picture. This is the max list. This is my go-to list. I put this together years ago with my trading partner. Here we go, from years ago. Amazon, that's a higher low setup. It's below the moving averages. Nothing to do with it. We had a buy right here on it. Okay, there's Amazon. Alibaba, this may eventually come off the list because it's so far. These Alibaba and Baidu have lost their luster. Okay, and they may come off the list. Facebook, there's nothing going on with this right now. You see these tops? I had them marked. Never triggered. Didn't buy it. Google, shopping around. Nothing to do with it. Got to leave it alone. Goldman Sachs, shopping around. Nothing to do with it. Now, I'm going to tell you all something. I love clean and simple bases. And now I'm going to show you why. The real world. Goldman Sachs going sideways. I said, if it takes out these tops here, this was on the key list, folks. True confession. You can ask the VIPs. I'm not going to lie to you. Why would I do that? It's like, gosh, if it takes out that wide line, that'd be pretty good. Oh, wow, it does it. Look at that. On a pickup in volume. We bought this. We bought this. The next day, it gaps down and it drops down below that line, and we sold it. Note the volume pickup. You can say, why are you pointing this out? Because I don't want to give the impression that everything works. It doesn't. But what's the real world? And this is why I like clean and simple base breakouts. Bill O'Neill talks about limited losses at 7-8%. That's fine, but ain't fine for me. For me, and again, it's ingrained on me. Hey, I had to make money supporting the family, right? Going sideways, price is good above the white line and bad below. It allowed us, and when it was dropping here on volume, we sold this for a very, very small loss. Very small. Which leads to another point. I don't day trade. I don't scalp. I don't look at 5-minute charts. I don't hardly ever look at 10-minute charts. I want it to go up And if it doesn't and fails, I'm out. And by the way, it's probably good we did, isn't it?
And Pat,
That
just curious, you said you like to keep it a lot smaller than that 7-8% loss. What on average would you say is your basically your average stop loss?
2%.
2%.
2%. And I do stress this, by the way. I don't day trade. I'm not looking at 5-minute charts. Oh, he's in, he's out. Folks, if that was it, well, we wouldn't be doing this webinar because I'd probably be dead. Okay. We don't do that, but we do run it really tight. And this is what I love. Again, price is good above the line and it's bad below. We just get out and it's simple. By the way, combine that with the volume pickup, it's gone. Let's continue on here. MasterCard lifted. I didn't do this one, but watch this. We talk about clean and simple. Look at the downward sloping trend line. Just connecting this cluster of highs here and here. I could have drawn the line. It's simple. Look at the volume pickup. Look at that. I'll make it a little bit bigger for you. The joys, look at that. Look at the volume. And it lifted. There it was. It's simple. Here's MasterCard. Took the line off, sorry. Microsoft, clean and simple base entry right there. I'll make this a little bigger for you. See this? By the way, this is the max list. I'm just going through them alphabetically. This isn't like set up to boast or anything like this. But runs up, and then we're selling. You see this big reversal bar here? And I'm going to make that bigger. You see that bar where it gaps up, runs up, and reverses down on a pickup and volume? Guess what we're doing on that bar? We're selling. Last year sold on that bar. That's it. Lost that neckline, it's sold for a profit. Gone. Continue onwards. Netflix. There's nothing here. What's there to do with it? You're not going to see this in any chart book say, oh, this is the setup that you look for. No, there's nothing there. You have to leave it alone. Was it good at one time? Yeah. Some of you have seen me post this before. Here, buys here, and buys here. Max list stock, right there, right here, right here. By the way, on this bar, right there was a volume pickup. You see that versus those previous 5 bars? Right there. Buy, trends. Then it finally faltered around. We sold the rest and we were selling up in here. And we were selling the last year, and the last years were sold right there. I haven't marked. See that? Why? It was dropping down on heavy volume. The rest of it's gone. Square, this is another one that may eventually come off the list. This was really good, but it's just dead. There's nothing to do with it. NVIDIA, we showed this one already. The higher low setup. VIPs own it. Have sold some. Why? Because it stopped at the 21 day. Here's Tesla. Nothing to do with Tesla at this point in time, just chopping here a little bit. Few people own it off the bounce off the 200 day. We're watching it. They own it down lower. We've sold some. See that right there? And I will tell you this. See those price alerts? We will not lose money on this stock. You say, well, that's not much money. Dang, near 90 points. I don't think that's too bad. By the way, I need to pause here and share something with you. I don't day trade. I don't scalp. I don't look at 5-minute charts. It's too much work for too little money. I want to buy something and ride it for all that it's worth. Like right there. See the clean and simple? Watch this. There you go. It's like, gosh, just clean and simple tops there. I guess if it goes across that line, that'd be pretty good. Oh, gee whiz, it did. And it did it on volume. By the way, I can document this. Yeah, we bought this. Okay. Look at the trend. There's a lot of work. And you sell some into strength and you're done. That's it. Twitter, all I can say is this. The tweets ain't helping. That's a problem right there. Okay, nothing to do with it at this point in time. But maybe eventually it will change. Okay, and then finally Visa. Visa, what's the sister stock of Visa? MasterCard. Visa pushed through. Look at the volume pickup on this. I didn't buy it. Okay, but you can see it. There's Visa and there's MasterCard. You see how things come together as far as groups, themes? But the key point is this. Please, I encourage you, focus on clean and simple basing patterns that everybody can see. And I'll even show you one here. You can say, well, there ain't nothing there. There's nothing there. There's nothing there. There's nothing there. Clean and simple downward trend line, breaking off, pushing off the 50-day. We bought that. You can say, well, that's not much. 30, 40 points in a shorter period of time. I don't think that's too bad. And little shelf there that didn't too much. I think we can find another one in here that worked. Yeah, right there. Little base right here. I remember this back in May. This is 2020. That's a nice trend, folks. That's just a low stress trend. See this walking up the 21-day moving average? By the way, I need to share this. 200-day simple, 50-day simple, 21-day exponential, 8-period exponential. And that helps us, makes it easier for us. Anyway, okay, Richard, if you've got another question or anything like that, or anything you want to talk with, we can sure do it, good buddy.
Yeah, absolutely. A lot of people, when I asked on Twitter what they'd like to hear from you, is basically a walkthrough of how you sell to strength. So I think a great way to do this would be to pick maybe a previous Apple trade and kind of walk through all the way from the buy all the way to you're selling the last shares, and not just walk through the chart, but also walk through the thought process behind all the different actions, and also kind of also talking through if on that buy it reversed on you, what actions you would take intraday to basically mitigate your losses.
Great question. Great question. Thank you. See the clean and simple buy here? And I'm going to slide. Something I'd like you to all to do is please, I encourage you. You see the clean and simple buy? Slide charts to before something's happening. And I know you can say, oh, from a perceptual bias perspective, we knew it worked. Okay, so we're cheating. Well, just train your eyes to look at it and say, gosh, those are some clean tops. It will really help you. Walk through it bar by bar, and it lifts right here through that clean tops, and it does it on heavy volume, and you let it work.
And where
And
are
it
you
lifts.
buying on that day, Pat? Sorry to interrupt. And are you looking at an hourly chart to look for that pickup in volume intraday? Can you talk about that process as well?
You got it. When it's pushing through, thank you, Richard. When it's pushing through that bar, and I apologize, I didn't address that. When it's pushing through this bar, here's what I'm doing. It's in the morning, it's lifting off. We'll assume it's in the morning, or even any time of the day. What do I want to see as it's happening on that bar right there? I instantly, and the VIPs know this, I instantly take it to the hourly chart and look at it. If the volume is heavy on the hourly bar, that's good enough for me. I buy. If the volume on the hourly doesn't show much and it's near the open, common sense dictates. Take it down to the 30-minute bar. The market's only been open for 10 minutes. The volume's not showing up on the hourly. Take it down to 30-minute and see if that volume surge is there on this bar. And if it is, that's a buy. That's it. That's a buy. If it's really early, like maybe the first 10 minutes of the day, take it to the 10-minute chart. All right? Hourly, 30-minute, or 10. If you see that volume surge, a big surging volume on the 10-minute chart pushing through that line, it's a buy. Also, remember, rules of proper pyramiding, as we discussed earlier with the canceling program. Never make your first purchase the full purchase. If your goal is to get to 100 shares, your first purchase should be 50 shares maximum. That's all. Why? Because if it fails, your loss is also much smaller. That really works. That's the nuts and bolts in it. That's the real world. And you buy it, and it works. So we start with the daily as it's breaking out, and it could be breaking out right at the open. It could be breaking out 2 hours after the open. It can be breaking out any time during the day. But as it's breaking out on the daily chart, look at the hourly chart, look for that volume surge, or the 30-minute chart, or the 10-minute. And the hard and fast rule that I have at Mission Winners, if volume isn't coming into it, I'm very pragmatic. It tells me something. Other people may see what I see, but they're not buying. And if they're not buying, I'm not buying. I want other people to see what I see. I want that confirmation, and it's measured in volume. They don't see it, I stay away. Like I said, I want other people to see what I see, and they're acting on it, because that's what it takes. Be pragmatic. I'm not going to move the stock. You're not going to move the stock. All right. But if other people are seeing it, that volume picks up, confirmation for buy. And we did. And we did. On this one, that was a buy.
And if I could ask one more question,
Sure.
once you do that, place that first buy, where's your initial stop loss, and would you touch your stop loss level at all during that day?
Great question. My stop loss is if it's real simple, and this is a great question. Richard, you should do these things more often. This is really good, buddy. No, this is what I always say, and it's really simple, but it works. Price is good above the white line and bad below. That's it. And the best ones, this is something you will find. The best ones will just push away and go. And there'll be that volume surge. Focus on that. But let's flip that coin. Let's suppose they don't. This is the best part. As I stated, price is good above the line and it's bad below. If this thing starts falling below that line and maybe some volume pickup on the 10-minute chart or the 30-minute chart, it tells you that you were wrong and you sell it. And here's the beautiful part about that. You're selling for a much smaller loss. And remember this, I'm going to flip this coin. I mean, I'm wired really tight about this. I had to be. Never, if your goal is to get to 100 shares, please, I'm asking you, never make your first purchase 100 shares. Please don't do that. Always start with 50 shares maximum. If it continues, buy 30, continues, buy 20. If it doesn't, if it goes up and starts to fall, you only have 50 shares. All right. Now that's using the assumption that your goal is to get to 100 shares. Naturally, if your goal is to get to 500 shares, the number would be bigger, but judge accordingly. So be really good at buying, but be really good at selling. Be really good at controlling risk. A lot of people don't talk about that, but it needs to be talked about. And it's something we do at Mission Winners. I'm not negative. I love stocks. I love this stuff. I wake up at night thinking about it. But you can say, you need to get a life, buddy. No, it's just the challenge of it. It's so rewarding. But always remember, control the risk. It's good above the line and it's bad below. But also stack the deck in our favor. We know, because I read it to you, focus on stocks in leading groups that have great earnings and are great sales and a high composite rating and an accumulation distribution of A or B. You will dramatically improve your investing results. That's a cold hard reality, folks, and it works. And the other point I want to make, I said it earlier and I'm saying it again, ride trends. Ride trends. Earlier in this interview, people say, oh, you'll never go broke taking a profit. That's a lie. If your losses, if you every time you're up 5 points, you sell and you consistently have losses of more than 5 points, you can lose your money. I don't want you to do that. I want you to succeed. So control the risk, but ride trends for as long as possible. You can say, well, how long is that going to be? I don't know. Do you? No, you don't. But if you have like the 8-period exponential moving average or the 21, you sell some into strength and you can weather this. That's a nice trend. Look at that. Look at the walk up to 21 day. Isn't that beautiful? Finally starts to lose it. You take the rest and say, fine, I'm happy. This whole move, by the way, I never looked at any 5-minute charts. I rarely looked at 10. I didn't need to. Just look at this and let it guide you. Now, speaking from my heart, I wish somebody had said that to me a long time ago, but it was before the internet. So we live and learn. We live and learn. Here's the beautiful thing for all of you. You're light years ahead of gaining good information on the internet. And again, Richard Moglen, the videos that he produces, these are good training, coaching videos. It's not hype. It's not get rich quick. In fact, I'm going to tell you all something. And I haven't said this to him yet. If I thought he was kind of a charlatan or something, there's no way I'd do this. No way. I don't do that. The idea is focus on the clean and simple. That's what he talks about all the time. Things that are conceptually correct. Key on that. And always limit losses. Stress that enough. Folks, I was there for the crash of 87. You don't want that to happen. All right. I was also there for the flash crash of 2008. You don't want that to happen either. So anyway, I had to get off on a tangent there, but I think it's things that are very important.
Absolutely. And just to kind of make sure I understand. So basically, once you buy through that pivot, you're very quick to your stop might even be break even at that point once it pushes through a little bit, and you'll cut it very quickly if it pulls back below.
That is correct. If I'm up several dollars, not 50 cents, okay? I mean, that's
Yep.
too close. But if I'm up, and it's a good clarifying question, you should do these interviews things. These are really good. No, if you have a clean and simple entry, you've got a clean and simple exit. But don't get so wired tight that, oh gosh, it's down 20 cents. It's dropped 20 cents off the highs. No, let it breathe. Let it breathe. The beautiful part is this. You will find through experience, when it pushes through a clean and simple spot, everybody sees it and they just go. And the biggest problem you have is you can't get enough shares because they just run. It's an awesome feeling, but never argue with price. Never. Keep losses small. It'll keep you in the game forever. But at the same time, don't limit profits. Ride them for all they're worth. And by selling just 20% off, or maybe another 20%, you've guaranteed yourself a profit, but more importantly, you've minimized that psychological stress of, oh gosh, what am I going to do? What am I going to do with it? You've already guaranteed yourself a profit. So you can think clearly, which allows you to make better investing decisions because we're not amped up about it. We're just kind of resting. So anyway, that being said though, too, please never get sloppy with your stocks. All right. Manage them. Manage them. Psychological perspective, you sell 20% off, you've guaranteed yourself a profit. It allows you to think clearer. Leads to another very important point. If you're ever going through a really rough time or somebody in your family is, as I said earlier, back off investing. Okay. Yeah. It's too hard. Saying it again. All righty, good buddy. I'm ready for more if you want.
Yeah, absolutely. So sorry to keep hammering on this point, but before you move that stock to break even and it's just kind of oscillating right near that pivot, obviously we want to just go and never revisit. But is your initial stop at the low of the day, or are you just kind of watching it with alerts to make sure it doesn't fall too far below that pivot at that initial buy?
Great question. First stop, low of the day. If it takes out the lows of the day, I know I have a problem. Yeah. Okay. And then I'll start watching it and I'll take a look at it on the 10-minute chart, the 30-minute chart, and the hourly chart and see how it's oscillating and seeing if it's making progress. And if it starts to push, it's fine. But if it starts pulling back down, especially on a slight pickup in volume, like on the 30-minute chart, I'll get out. I'll take it out because I know I'm wrong. And through years of doing this, I'll say this again, and this is important. The best stocks, the biggest problem you'll have, you can't get enough shares because they just go. That's why I'm really hung up on clean and simple basing formations. It increases the odds that other people see what we see and they're buying too. And that's what we want. I can't push the stock. Nobody can push the stock by themselves. But together, that volume comes in, we've got confirmation we're on the right track. Also, I do need to share this, though. I think this is important. Please, I'm asking you, never get arrogant, okay, or ever think that you've arrived, that, oh, we got it. No. For most people, research has indicated, and this isn't me talking, this is actual research. Most people, the research points out, their biggest losses occur after a string of good profits. I'm going to say that again. Their biggest losses occurred after a string of good profits. Never get the Midas touch that everything we do, we're invincible. Manage each stock on its own. And I say this all the time, and I used to say this at the IBD meetup all the time, every month. If you're not humble, the market has a lot of ways to humble you. Be careful with that.
Absolutely. Completely agree. And now moving forward, we've gotten that buy out of the way. What are you looking for to sell some into strength, and how are you managing things with the 8, 21, and 50 as the trend progresses?
Good question. These are great questions. Folks, I compliment you for your questions. I love it. So it runs up. Everything's great. Good volume on this bar. Good volume on this bar. Good volume on this bar. But right here, it's extended in price. Do you see this? And this is a really good telltale sign. I'm going to make this bigger for you. Right there. This is, again, why I love price bars. If you want candlesticks, go for it. Look at where it opened. It opens. It runs up and then starts to reverse down. When it's starting to tail down, you know what I'm going to do? I'm going to sell 20% of my shares. You guys say, well, yeah, but it went a lot higher. Hey, I'm living in the now. I don't know the future when it's doing that.
Right.
Do you know? Do you know what's going to happen next? No. So what do? We'll lock some in right in here. Sell 20%. It completely eliminates stress. Less stress leads to clear decision making. Let's advance it 1 bar. Okay. Opens basically unchanged, drops and closes up. We're still okay. And it's trending up the 8 period. We're going to continue on this bar by bar. Is that okay with you, Richard? We do that?
Let's do it.
Okay. Goes up. Oh, look at this bar. You see this bar? It gaps down and it drops down. It loses the 8-day. Sell another 20%. Don't sell it all. Why? You're still up in it. Let's see what happens. And note, the volume picked up, but it's less than these bars. But you could sell some knowing you've lessened risk, you've guaranteed profits. Okay. And it lifts up again. It bounces off here. Now you've sold, just sit tight with your shares. Just sit tight. And it starts to lift. Now look at this bar though. See this? Bouncing off the 8-day? Look at the volume on that bar. I always say this, and I've said this for years at the meetups and at Mission Winners. People talk with their mouths and vote with their pocketbooks. You see that bar? They voted, folks. They voted. You start to see that happen, you can take this to a 30-minute chart, and I guarantee volume was heavy right in here. You could buy some of your shares back. All right? Now, rules of proper pyramiding. Let's suppose you bought 100 shares and you sold 20 shares and then you sold 20 shares more. Please don't buy another 100 shares here. Buy 20 shares so it doesn't screw up your average price. All right? Remember that. Always control risk. A lot of people think about, this is what I can make. This is what I can make. You got to think about what you can lose too. And that's not being negative. It's a business. We have to run it like a business. Igniting bar right there. People talked, they voted. You buy. Does this. Gap up and reverse down. If you bought near here, be careful with that. You could sell some. Sell the shares that you bought, but don't sell all of it. Just those shares. And please know, I'm not day trading here. Okay. Look at that. And that's why on a big reversal bar, you take a little bit. By so doing, you know what it allows you to do? Weather this. And what could you do here? When it's gapping down like that, and you don't know the future, you could sell some. Sell 10%. If you've got 100 shares, sell 10. It protects you. I know I'm being really simplistic with this. Transpose that number to the share size that you have, okay? This is where we're at. Chops around, starts to lift up again, starts to trend again. Everything's fine. We've sold some. I'm not going to buy more in here, okay? These are not clean and simple patterns. We'll just let it work. See that bar right there? Gaps up and reverses down and loses the 8-day. Loses the 8-day here. What could you do? Well, you've got an ugly reversal bar here on heavy volume. You've got an ugly reversal bar here. Gaps up and reverses down. You could sell some and frame it up conceptually. Watch this. Down on heavy volume. Down on heavy volume. Up on less volume than it fell. You see this? Price and volume. Don't buy more here, but monitor. The next day, gaps up, starts to reverse down. You could sell some. Manage it. Good investing is not all or none. Good investing is not, I'm in or I'm out. No, you can scale in and you can scale out, and it works. Support at the 21-day, all right? And it starts to lift up again. I'm not going to buy more here, okay? We'll see what happens. Starts to pick up. We're still fine. We've sold some through this. We're in great shape. Let's see what it does. Support off the 8-day. Now, this would be very aggressive, but I have to point this out. What do you see here, team? What is it?
Cup and handle. Yep.
You got it. It's a cup and a handle on a volume pickup right there. And it's, folks, let's go back. It's like this is forming a cup and a handle. Maybe if it lifts off the 8-day, that could be a potential to buy some. But always buy less shares than we originally owned. Rules of proper pyramiding. We advance it. And you know what's beautiful here, team? I want you all to think about this. You cited this, okay? You cited this and said, or you thought to yourself, hey, this kind of looks like a cup and a handle. You see how simple this is? Everybody sees it. Focus on chart patterns everybody can see. It increases the odds you'll make money. And guess what? They liked it right here. If you had 100 shares left, don't buy another 100 shares. Buy like 20 to 40 of them. Does this, and then it does this. And by the way, team, I didn't know what it was going to do before this. Okay, I don't have this chart up on another monitor knowing what's going to happen. I'm living in the now. And to me, that's the right way to do this is, yep. Oh, he's cheating. He knew what happened. I didn't know what happened. I got too many other things to think about. Lifts off, down here, you buy here, starts to fall. Those shares that you bought, especially if it loses the 8, you could sell them. And it does this, and you're out of those shares. Does this, starts to lift, shopping around, and then finally right here, see where this rallied up? And then it reverses down off the 21-day, and it starts to fall. You can give it room. We own it down here, and we've sold some into strength. We've got a small shares left. Finally loses the 50-day right here on a pickup in volume. You sell the rest and say, thank you very much. And by the way, those shares that you sold here, yes, you sold those for a good profit too. That's it. That's walking through an entire set. And people come back, oh, you do better if you sold it up here. That's cheating. I don't know the future. Nobody does. I have to live in the now. When we accept the fact we don't know the future, we see the future far clearer. And that helps us. Just helps us with clear thinking. And, and this is now. Shopping around. There you go.
Yeah, that was great to go through a full trade. And that's pretty much all I had as for questions in terms of charting. And unless there's anything else you want to talk about reading price action or anything, Pat, I think we can just move to wrap up questions.
Okay. I'll wrap this out here and share this. Please focus on the open, high, low, close on the price bars and combine it with volume. And remember this, focus on clean and simple entry patterns that everybody can see. Why? It increases the odds they will buy also. And when it's pushing through, look for volume confirmation on the daily, narrow it down to the hourly or 30-minute, and look for that volume surge. It will really help you. No volume, no buy. Why? It's telling us other people aren't acting on it, and we want that. So anyway, I know I've said that a lot, but it's compulsory to really drive home these points of successful investing. Another point I'll make, please never let a good profit turn into a loss. That's a cardinal sin. Another point, stay away from 5-minute charts. There's too much emotion in the 5-minute charts. Anyway, I wanted to wrap that part out too. I think that's very important for everybody.
Perfect. Yeah. Thanks so much, Pat. I love how simple you make chart reading. And I always like to end it off with just kind of one last question. What kind of general advice do you have for traders who are struggling right now, who maybe have gone through a drawdown and want to kind of move forward with their trading journey?
Great question. First, pull back in your activity. Secondly, and maybe it sounds corny, but I'm speaking from my heart, take care of yourself. Take care of yourself psychologically. Take care of yourself physically. I really mean that. Get up and go for a walk. Not when the market's open, okay? But get away from it. Don't vengeance trade. Don't try to get it back. Please have some proven, it's what we teach all the time, have some proven rules and techniques and some disciplines and get back on track. The other thing that's very useful, start smaller. If you normally start with 50 or 100 shares, cut it back by half. Cut it back to 25 shares. If you're not going to make money with 25 shares, you're not going to make money with 50. If you're not going to make money with 50, you're not going to make money with 100. Pull back. It protects us financially, but it also protects us psychologically. It allows us to breathe a little bit and just rest. I'm speaking from my heart here. I really mean, I've been through that. Okay. I know what it's like. I've had grown men call me up crying, going, what am I supposed to do? There were other words in those statements. So you pull back and regroup, start smaller, start honing your skills, start making profits. As the profits start coming, start picking up your share size only after profits have been coming. Always remember, never get too aggressive, never try to get back, no vengeance trading, but please focus on the clean and simple base patterns like we shared today. Focus only on that. Don't think that just because the market's open for business, you have to do business. Wait for the perfect setups and go for those. When you see them, because now we're going through and you said, we've got some psychological issue going on here. You got hurt. Okay. And I know what that's like too. I mean, anybody who says they don't have losses is lying. Start smaller, build on it, become consistently profitable again. And only after that has happened, then you can start to build up your share size. Always monitoring the market, always monitoring your profitability, always monitoring your ego. Never try to get it back. And after you use it, start experiencing consistent profits again, continue monitoring the market, and you can start building up your share size. Please, 2 types of capital in the market, financial capital and emotional capital. And I'm speaking from my heart. We have to protect both of them. Yeah. All right. And again, I'll say it, no vengeance trading. Don't try to get it back. And don't try to get even with a stock. It's not a living entity. It doesn't know you. It doesn't know you exist. Just watch what's happening and manage it accordingly. And take a breath. Periodically get up, walk away from the computer. That'll help you. That'll help you. So I hope that makes sense.
Yeah, I think that's great advice and a great place to end this interview. Pat, I want to thank you so much for your time today and for walking through those charts. I'll have the links to your website as well as your Twitter down below the description. But is there any other place that people, if they want to learn more about your style and want to reach out to you, should go, or are those two good?
Those two are good. On Mission Winners, so we produce a lot of, and thank you for asking me, we produce a lot of content there and trying to explain things in a way that's conceptually easy, conceptually correct, conceptually easy to understand and apply. And again, my background's teaching. I taught on the university level. My final was 24 pages typed. People hated me, but just trying to help people. And it's just like what Richard's doing. He's trying to help people. I'm doing the same thing too. And there's others out there, but I do stress, go easy, and build off that. It's good for us psychologically and it's good for us financially. Never argue with price. Never. It works. It's a very satisfying and rewarding situation. That can change your life. So I just be humble with it all. If you've ever find yourself getting arrogant, be careful. Just be careful with that. It's the markets are bigger than all of us combined. So it works. It works really, really well. When things are rough, have the courage to stop. The best investors I know, they stop. They won't do anything. There are days I don't do anything. It's not there. And I'm not saying, oh, I'm the best investor. No, that's not my point. If it's not there, it's not there. If a 4th grader can't see it, well, give up on it and wait. And then when things are good, hit it and hit it hard. And you'll see it grow with a lot less hassle. So, and it's also good, like I said, it's good financially and it's good psychologically. We got to protect what's going on between our ears. So I hope that helps.
Yeah, absolutely. Sweet potato pie. And for everybody watching, I hope you guys enjoyed. I know I always like chatting with Pat, and it's great to have him on. So go ahead and leave a like if you enjoyed, and subscribe if you haven't yet to the channel. And we'll see you guys in future videos. Thanks.